Good morning, I'm Randy Barkley, and I'm here with Jeremiah Lee, and we're here to discuss life's really difficult choices. I'm a certified financial planner, and Jeremiah is also certified, but he's also a licensed attorney. And we're going to talk about contemporary issues, things that are going on in the news today, obviously with a financial emphasis because we're financial planners. But today we're talking about, all this talk about recession is starting to scare people, and I guess the question is, what do you think the certainty is that we're going to have a recession? And of course, we don't know. We're sitting here trying to make estimates and we're reading the tea leaves just like everybody else is. But we're having a full employment recession. Mm-hmm. I mean, it's just an odd animal.
Which is, my understanding, has never happened before.
Right.
We haven't had a full employment recession. And from a fair amount of measures, when we talk about a recession, that's happened, right? We've clicked over that amount to say we're now in a recession. But the question is, how long will this last? When will we come out of it? And is it going to get deep? Like that's the scary part for most everybody. If this is just a minor recession, we turn around from here, people are going to be okay. If we've still got another leg down, it's going to be troublesome. So I mean, some of the things we've been looking at are conflicting. Like you said, we have really low unemployment, which for a recession is odd, and so odd that this is a unique case that we are fully employed and the economy might just be crawling along.
Yeah, and a lot of economists are talking about what they refer to as the participation rate. And a lot of this occurred when we had COVID and people retired early. Mm-hmm. They said this was a good time to step out, and they moved away from their job and they moved into retirement. But they also got money. Companies got money and individuals got money. And this added to, I guess it created slack. I mean, people have the ability then to not work. Mm-hmm. But then when they had that money, think about it, they could go out and spend it.
Right.
So within the services community and other goods and they wanted to buy, they started to buy more. But then there was this pullback in participation rate. There wasn't the number of people that were working as they were before. And all of a sudden we got this unemployment participation problem, but we got this demand for goods and services that have climbed dramatically. So we have now what we call is we have potentially a recession with full-blown employment, which is just really odd. It's an odd characteristic.
And what does that mean for everybody? Does that mean we're going to come out quicker? Does that mean it's going to take longer? Does that mean we have no tools to fix it? I think there's a lot of questions, and we talk with clients on a regular basis of these types of questions, and some of them there's good answers to. Some of them there's not. I think the question that I get the most is, how long is this going to last?
Right.
Or kind of when do we know it's done, I guess is the better one. When do we know this is done? And we're going to talk about a few of them. There's a few kind of telltale signs that people use, but the reason that they're not absolute is because they're not always there.
Right.
So a big one, people might hear on the radio or talking heads or even your own advisors to say that investors have to capitulate. And retail folks who are investing in the market, they just have to give up and say, I can't take it anymore. It's too much. I've lost. I'm out.
In other words, the fear level reaches so high that particularly small investors, they just say, I got to get out. I can't stand the pain anymore. I can't stand the emotional upheaval. And they just hit the sell button. It doesn't make any difference what's at the other end of that button. They say, get rid of it, get me out of it. Yeah. And we're, a lot of, I guess, professional investors are kind of looking for that point, right?
Button. And the idea that sometimes that happens. Sometimes there's so much pain in the market. You see, sometimes people call it the market puke. Everyone just gives up and gives in, and then from there it turns around and goes up. But it doesn't always do that. Sometimes it just kind of peters along and then takes off. We were talking this last week with some economists of whether we're, have one more leg down to go, or if we're at the bottom, or two more legs. I mean, there's some uncertainty there. And if it was certain, if people could decide that there's this one triggering factor, it would be easy to peg, but it's not. The other aspect is people will sometimes say, well, stock prices have to get cheaper relative to the earnings they have. They call the price to earnings ratio. That just has to come down. And it's been coming down as the markets fall. But there's been a number of recessions where the earnings came down with the prices, and that price to earnings ratio didn't really get to some magic number, and the economy ended up turning around.
You got to remember that a lot of the information that they have historically was based upon when interest rates were higher. So mortgage rates have been, right now mortgage rates are somewhere in the 5s. So on a 30-year mortgage, you can borrow, if you're a qualified borrower, you can borrow somewhere around 5.5%, 5.6%. But historically, that's actually a pretty modest mortgage rate as compared to what it was 10 years ago, 20 years ago. And those factors come back in to determine stock or the PE ratio, the valuation. So a lot of analysts have said, wait a minute, with interest rates this low, stocks could rise higher than what they have in other times in comparison. And I think to some degree that's what's going on.
Yeah, that's a piece of it. And as interest rates go back up, we might see some natural falling
Right.
of prices to say interest rates are getting back to a more normal level. That might lower prices. I mean, that could be part of it.
And you know as well as I do, the bond, we look at not only the current bond rates, but we also look at the 5 and 10 year. But that's telling us that inflation is not a major factor in the bond market. The bond market is actually a stronger indicator of where inflation is going to be than the stock market. And if we look at the 10 year is settling in at about 3% or so. It's not something that is considered, I guess, falling off the rails. We have a lot of indicators that would indicate that inflation is not going to be as strong as a lot of people feared. In fact, a lot of things are coming down. Lumber's coming down, copper's coming down. We've seen oil prices come down. A lot of these key components that drive inflation are starting to drop.
Yeah.
Again, labor costs are still higher because there's just a lack of people working, right?
Right. And the disconnect is that we just had a inflation report come out, and I think it was, 9%?
Yeah, but remember, inflation reports they're lagging indicators, not forward indicators.
Yeah,
So
that's a good comment. And so you see, inflation going up, but some of these commodity prices coming down. Oil's come off its highs. It's mixed signals, and I think
It is
we get
mixed
an
signals.
economy where we're getting mixed signals from various parts of the market, with full employment generally, very low unemployment, and the economy still moving forward, but potentially at a snail's pace. It's a unique moment. And one of the things go ahead.
But I mean, this week, we've seen the market go through a lot of volatility. I mean, the market was negative for so many days, and then all of a sudden, earnings reports come out on Friday, and the market took off. It's up over 600 points. It jumped almost 2%, which seems so diametrically opposed to what happened earlier in the week.
Right.
But it was the initial earnings from Goldman Sachs as well as from J.P. Morgan Chase, but then other banks did okay. They did okay. So
well, on that comment, and getting away from some of the doom and gloom you hear probably on a lot of the news, there's some really good news. One of them is exactly that it used to be probably 3-4 months ago, any negative news and the stock price would just plummet.
Right.
We saw that. Netflix came out. Had less than desirable earnings and subscriber base, and they fell significantly. Well, this last week, Mark Zuckerberg came out with Facebook and came out to say, had some negative news, saying this is one of the worst markets ever, and their stock fell 1%.
Right.
It wasn't a significant, even with this very bad news coming out from the CEO, it wasn't a significant event. So I think that's part of it. The other thing that's useful is you're seeing company buying back their own stock. So they see this as a good deal in essence at the moment. The other thing I think is just so interesting that I think that a lot of people are missing is right now there's $27.8 trillion in home equity in the United States.
that's huge.
That's the highest ever.
Ever.
And so to a lot of people see that and say, well, new home buyers can't get in. Yes, that's an issue. But for a lot of other folks who own homes, they're in the highest equity positions they've ever been in the history of our country.
And then you combine that with the amount of cash that people have. I'm not talking about companies, because companies have a lot of cash too, but individuals. There's just a lot of slack. There's a lot of excess capacity that's within the marketplace we're not as fearful of a recession as some people would predict, I guess.
And a long recession. So part of one of the things I want to talk about as well is, I think I mentioned on the radio kind of the last time, was we talked through how long recessions last. And historically there's some averages. So one of them is peak to trough, from the top to the bottom. It's generally 16 months. From the bottom back to the top, it's generally 24 months. And the whole thing, on average, is 40 months. So 40 months for a recession. So, but that's the average. So to really dive into that a little bit. So back in 2007, 2008, it was 65 months. When housing kind of fell apart, 65 months before things were back to the peak. That's peak to peak. Back in the 1980s, 1980 and 1987, it was like 23 months. So just about 2 years before we were back to the top. People remember 2000, the dot-com bubble, it was 86 months. It's really long. And so and then more recently, you talk about how the markets are moving faster. March of 2020, not that long ago,
Yeah.
it was 6 months. 6 months before we were back to the peak of when it fell.
Yeah, that's
and
what
came
we
back.
refer to as a V recovery. It went down very radically, but it also recovered radically.
Yeah.
And it's unusual to see the markets respond that quickly. But of course, a lot of that came from government stimulus. The government pumped a lot of money into the marketplace.
Yeah, and the world responded, to COVID,
Yeah.
and that was a shock item. So with that, when you think through, a lot of our clients will talk through their portfolios. If you can't, handle a 2 to 3 year struggle where the market's down, well, then that's money that should probably be in a savings account or a CD,
Right.
not in the market. But when you're able to stomach and financially endure through a 3, 4, 5 year recession, then statistically speaking, you're able to be fully invested in the market. And when something like this comes along, you hold tight, you hold on to the ship, and you take the opportunities to rebalance if you need to, but not to exit the market, not to flood, not to have these emotional reactions.
Yeah, we constantly review our holdings to make sure that we feel comfortable with the positions and the allocations that we have right now. Again, what we've done is we've selected assets. We knew that interest rates would go up. We didn't know how rapid they would go up. We knew that inflation was coming. We just didn't know exactly how much inflation was coming. Remember, that word was called transitory. Nobody's talking about transitory anymore. They feel like it's more embedded within things. Inflation will go away. I think the Federal Reserve is really their primary concern is not employment. Their primary concern is bringing inflation under check. And I think because they're so focused on that, inflation will come down. They'll come down to probably by the end of this year, for sure by next year. It'll come back down to what I consider historical numbers, 2 to 3%, somewhere in that neighborhood.
Yeah,
So
and it'll be interesting to see as we get back to normal inflation what that does for the economy. If the recession type aspect will endure despite having regular inflation, or if it picks back up. I mean, the hope with bringing down inflation is that the economy has a steady pace.
Right.
When it's going too fast, we get inflation, it gets too hot. When it goes too slow, we call it a recession. It's really that medium, constant growth is what we're looking for, and that's that growth in productivity, growth in the economy is what allows people to have jobs, get reasonable raises, have some be able to move jobs, and that's that kind of liquidity we want in the markets.
yeah, I mean, again, I think for a lot of people, particularly in household formations, this is a really difficult time.
Yeah.
I mean, if you live in Southern California and you're just starting out in life, you're recently married, and if you don't have an inheritance or help from your family, if you're working what I consider a normal 9 to 5 and building your family, it is virtually impossible to get into a house right now.
Yeah.
To save up the 20% that's necessary to get into the down payment, to raise a family, the obligations to not only your wife, your spouse, your husband, your children. It is. We recognize that, and we think that particularly on the East Coast and the West Coast, we're turning into a nation of renters. We're not turning into, because home ownership is becoming less and less viable for a lot of families just starting out. So that's going to be a hard part to swallow, so to speak, I guess.
Yeah. If you have a topic you'd like us to discuss on a future episode, feel free to leave it below in the comments or go to our website, retirementunlimited.com.